Thank you, friends, for tuning in once again. We come into another session in respect to our revision for financial reporting. Remember, we have been having several sessions in respect to May 2015, the past paper. So we have been doing these questions. And this is our fifth, as in respect to this particular paper. This is our fifth session for this May 2015. Now we come to the point of doing question 5. I want to do question 5 and see how far I would go. Question 5, at a glance as I can see it, is a question dealing with partnership. Remember, at this level in section 3, we talk about partnership as far as accounting for conversion is concerned and accounting for dissolution of a partnership is concerned. In the previous syllabus, before the May 2015 syllabus, we had the 3 realignments. One, we talked about dissolution, we had conversion of a partnership, and we had amalgamation of a partnership. But with the new syllabus, we are only dealing with the 2 realignments. We only talk about the conversion, and we talk about the dissolution of a partnership. So with this question at a glance, I'm saying from even the required point of view is actually a dissolution of a partnership. So please, I need to remind you that we are still talking about May 2015, question 5. This time round, we are talking about question 5. Maybe I believe this will be the last session for this sitting because we are doing question 5. Definitely, we don't have question 6. We are doing question 5 today, and I believe it will be the end of this paper. But we are going to do many other several papers, don't forget that. So we go directly to question 5. We read it as usual, we explain, and we even give the plan of attack. Then we do the question as required. Ebo, Brave, and Carl have been in partnership sharing profits and losses in the ratios of 2:2:1 respectively. Their financial year end is 31st December. Ebo died on 5th June 2014, and the surviving partners decided to dissolve the partnership. From that date, the terms of dissolution were that the assets were to be realized, outstanding debts paid, and the remainder to be shared by the partners. The share of Ebo to be paid to the executor of his estate in an equitable manner, distribution of cash being made as soon as possible. The following is a statement of financial position of the partnership as of 6th June 2014. Ebo, Brave, and Calm. We have the statement of financial position as of 6th June 2014. We have been given the non-current assets. Those are the book values. Land, plant and machinery, fixtures, motor vehicle, intangible assets, that's goodwill. Current assets, inventory, trade receivables, bank balance, and cash balance. We have the capital accounts, we have the current accounts, long-term liabilities, the bank loan. Current liabilities, we have our trade payables and bank overdraft. Total capital liabilities, we have it, addition information 1. Dissolution expense amounted to 450,000 and were paid on 30 November 2014. 2. As soon as sufficient money was available, all outstanding creditors were paid after the discount received, which amounted to 250,000. 3. The partnership had an insurance policy on the lives of partners in the event of death. The premiums had been charged to insurance expense, and the cash payable on death of any partner is 10,000, or rather 10 million. Number 4, the assets were sold and the monies received in a piecemeal basis as follows. We have the date, 30 June 2014, and we have the particulars and the amount. 25th July 2014, we have 20th August 2014, we have the 15th September 2014, and we have the 20th October 2014. Required: A, statement showing how the proceeds of the dissolution will be shared between the partners. B, realization account. C, partners capital account. That is 20 marks. Now from the required point of view, The statement to show how process of dissolution will be shared between the partners is simply a cash distribution statement. We need to see how are we going to distribute to the partners the cash available. Remember, we have two methods that we normally use for dissolution, or rather for distributing cash to the partners in respect to their capital balances. One is the maximum potential or opposable loss method. Two is the capital surplus method. Remember, the maximum potential loss method is very common. This is an assumption where that at every stage of realization, there will be a loss, meaning there will be some assets that will never be realized, and those assets will be assumed to be obsolete, and therefore a loss is determined at every stage of realization. Any asset not realized at the first stage of realization is considered to be worthless, so a loss is determined. The second stage as well, any asset that has not been realized is considered to be worthless, then a loss, a possible loss is determined. That's what continues until we exhaust all the assets. Now that's the maximum potential loss. The maximum potential loss determined will always be shared among the partners using the profit and loss sharing ratio. So the process continues until we complete or we sell all the assets. In the capital surplus method, the partners will be graded. We are able to group the partners from the strongest partner to the least strongest partner. In this way, we are able to allocate funds to the partner with the highest capital per unit of profit. Until that point in time, we are able to distribute cash to all the partners. Once that's been achieved, then now the partners will be given cash, or cash will be distributed to the partners according to their profit and loss sharing ratio. Now, that one aside, because maximum potential loss method is common, we'll really prefer to use the maximum potential loss. Realization account, in realization account, we are going to debit the realization with all the assets at their book values except cash or bank balance. We are going to debit our realization account with the dissolution expense. We'll also credit our realization account with all the cash proceeds when we sell the assets. We're also going to credit our realization with the asset taken over by a partner, also with the discount received. The balancing figure in the realization account will either be a profit or a loss, which we share using the profit and loss sharing ratio. Then you need to remember, we have the partner's capital account. We have to close the current accounts to the capital accounts. We'll have to debit any payments to the partners on the capital's account. We need to credit the partner's capital account with any realization profit or with any liability taken over by a partner. So that's what we're going to do. But at the end of the day, you need to remember, friends, our partner's capital account will not have a balance because we're going to pay them, remember. Now, on that note, we go directly to this question. What will be the plan of attack? Now, the plan of attack in this question is first to start with the cash distribution statement, where you note first the cash that will be available for the partners. You must pay all the creditors. You must pay all the dissolution expenses. You must provide all the liabilities. Then any cash available is what will be used to be now paying the partners' capital balances. We must settle the creditors. We settle the dissolution and any other liability. That's what we do. Then from there, we go to other ledgers, realization account. We also have the partner's capital account and the bank account. So you note that from additional information, we have number one, the dissolution expense, which will be used in our cash distribution statement. We must recognize it first. We must pay it first. We must provide funds for the same. Number two, apart from that, In our realization account, we must debit realization with credit bank with what we have paid as dissolution. Number two, we have been told there was a discount that was received. So we need to pay the creditors. So the creditors will be provided for will be the creditors net of discount in our cash distribution statement. In our ledgers, we need to debit the creditors with credit bank. We also need to debit our creditors with credit our realization with the discount received. Three, the partners, there is an insurance, that's an information they have told us that they have a cover. In case of dissolution, there must be a surrender. Or in case a partner dies, then they must be given that kind of money. We have been told, number four, how some cash was realized, on 30th June 2014, on 25th July 2014, like that, and so forth and so on. Now, let's try to look at this. We start looking at the cash distribution statement directly. The cash distribution statement there are three partners. So I need to make 4 levels. There are 3 partners. So I need to make 4 columns. This one will represent the total. The names of these partners, one of them is Able, Brave, Calm, so you start with the balances. Cash balance, the cash we have the cash balance of 2,300. We have the bank balance of 800. The cash balance is 800, but the bank balance is what we have as 2,300. Now, from there, we need to see whether we are able to pay, all the liabilities. Are we able to pay the creditors? Are we able to pay the dissolution expenses or any other liability? Now, like if I take just at a glance, I look at the cash we have is simply 800 plus 2,300. That's something like 3,100. That's what I have. Let's try to see how much are we required to pay or to settle first before we pay the partners' capital balances. We come and say, from the balance sheet, we have the bank loan of 40 million. That's like 40,000 now. We have the trade payables of 8,300. We have the bank overdraft of 16,000. It's apparent that the amount we are required to pay is 40,000 plus 16,000 plus 8,300. We subtract the discount. There was a discount given. Let me now recalculate that. We are saying there is a discount we were given of 250. So we need 64,000, and this is what we only have. In fact, if you notice that, you realize that even there's a bank overdraft, fine, that's no problem. So what we are going to do, we need to realize money. We do realizations until we are able to pay the 64. How did 64 come about? 64 came about by taking into account all the liabilities that we need to square out. So in that case, we need to do realizations. Let's go to the realizations. Note number 4. First, there is 30th June. These 30th June realizations. That one, 30th June realizations, I can say it is 10,000 plus the 4,000 plus the 45,000. For 30 June is 59. If you take the 59 plus the 3,100, we have 62. And we need to square out 64, remember? So we need to move on further and do realizations. That is on 25th. How much did we realize on 25th July? You take the one for plant and machinery. We sold plant and machinery 10,300. We also sold 6,500. Only 2 plant and machinery and trade receivables. So we have 16. Now, definitely here we are now able to pay, because if you add that one, you add the 59, you add the 3,100, is coming to 78,900, and we were to pay 64 something. So let's come and now get the total cash. Now we start paying. Now we pay. First, we provide for dissolution expenses, which is 450. We have the creditors. Creditors, we provide less discount. Less discount. 8,300. The discount is 250. So 80/50. There's a bank overdraft. That is 16,000. There's a bank loan. Bank loan is 40 million or 40,000. Now we are able to determine the cash available. So I come and say 78,900 we have a balance of 14,400. That's the cash available that we have to use to pay the partners' capital balances in their first cash distribution. So I come and now, after this, I find out the difference between the cash available and the total capital balance. So I must bring down the capital. The capital balances for ABLE, 25,000. For Brave, 16,000. For Calm, 10,000. The total of which is coming to 51,000. Current accounts, we also have the current accounts. The current account for ABLE is 8,000. The current accounts for Brave is 5,500. So Calm is like doesn't have a capital account balance. So the total of which is coming to 13,500. So this comes to 33. This comes to 21. This comes to 10,000. And the total of which comes to 64,500. So I bring in ILS, cash available. Remember, this was cash available in July. So the cash available in July is 14,400. The difference, we call it maximum potential loss. Which I'm seeing to be 14,400. That's 50 100. This maximum potential loss is shared among the partners using their profit and loss sharing ratio. That was 2:2:1. So I share that. That's the total of 5. So I have 10. Now, after we have shared that, we now subtract it. Because of space, I love now to go to the next page. Now, I'll come to this page and say, I'll apportion it still the same way. We have this. So we still have the 4. This is the total, is the continuation. Able, brave, and calm. So after the maximum potential loss, we have shared that. Now we have the balances. 33,000 minus 2040. We get 12,960. The 21,500, we subtract 20, 40, we have 1460. The 10,000, we have 20. Now you realize that C has a debit balance. Since C has a debit balance, we cannot continue until we distribute or we share that debit balance among the remaining solvent partners. So the rule of Ghana versus Bray will be applied here, where that 20 will be shared using the capital ratios before dissolution. In fact, our capital ratios before dissolution are these ones. We are talking about 33,000, 21,500, and 10,000.